Well, thank you very much. This is Stacy Francis, and welcome to our weekly roundup that we host every Monday at 8 a.m. and will continue to do so in the future, especially during these very volatile times, particularly in the market. Today, we're going to be talking specifically about financial resiliency in times of uncertainty. And Paul Stages and I are going to be presenting today. We've got some really important information for you that is going to give you hopefully some peace of mind and direction of how to navigate these very, very choppy markets. Um, Paul and I have worked together for nearly a decade, one of our most senior, established, esteemed advisors here at Francis Financial.
Thank
So
you,
I'm very,
Stacy, and
I'm
good,
talking you up. I'm talking you
yeah,
up.
and good morning to everyone. Thank you for joining us.
It's great to have you here. And Paul, I know that part of the reason why we are doing this is to make sure that individuals understand and hear the real facts about what's
Mm.
going on. Because I know that if you're looking at CNN, you're looking at turning on the TV, which FYI I do not do around the children. There's a lot of misinformation and out there as well. So that's what we want to do today, and we're going to go through a recap of last week's presentation. To again, if you weren't able to join us, just quickly recap that. We can also send you the recording, and with that, I say also know that this presentation is going to be recorded as well. I know that if you're here today, you most likely have friends and family and other loved ones and colleagues that have questions about what's going on in the market and in the world and the economy. So please do share this link with them, and they're welcome to join us every week live if they have time here at 8 in the morning. We're also going to talk about recent developments, what we are seeing coming out of Washington. Outlook and portfolio positioning, and Paul's going to really dive into that for us. Financial resiliency, something that has been spoken about before, but today means more than and more important than we've seen in many years. And at the end, self-care. I know that that doesn't sound like something that should be in a financial presentation, but your wealth is only important if you have health. And we know that health is the most important. So we're going to talk a little bit about that. Also, we're going to have some opportunity to ask questions, and you have the chat bar there. We had a few questions already sent in this morning that we're going to be going through. So we already have some on the docket. If we don't get to everything, don't worry. We will reach out to you personally to make sure that you have the information and the answers that you need as well. So, all right, Paul, you ready to get ready? Ready to get going? Perfect, perfect. All right, he's on mute, but
I'm ready.
they're ready. Okay, so last week's presentation, we spoke specifically about the coronavirus and oil. It was a very big week. The markets reacted with the oil news, the coronavirus news as a pretty big sell-off. But what was interesting is we saw the market really oscillating through the week. We had big sell-offs followed by some days where there was, you know, unbelievable gains, so much that they had to actually put holds and freezes on the market because the gains were so significant. We typically don't see that too often. We also saw oil prices and deep deep discounts, inciting some global fear. I actually drove out to New Jersey to a trail that very few people know about. I can tell you about it. We did not see one person while hiking, and it was wonderful to get my family out there this weekend. And we went to the pump and filled up our tank, and it was less expensive than we've seen in years. So some positives, but as you can imagine, some negatives for the economy, particularly the U.S. economy. We saw the Federal Reserve jump into high gear. They cut rates as well to 0%. We're going to talk a little bit more about that and what that means for your pocketbook going forward today. And, you know, the Treasury Secretary came out and said that while we know this is obviously going to have a impact on our economy, it's going to be another 3 to 4 weeks for us to really see what that is going to look like. So that literally is a 30-second recap of our presentation last week. It's a great presentation, and it tells you a lot of the fundamentals that you need to know about. So I do encourage you to reach out to us if you would like to have a copy of that and the recording. So we have some recent developments, and first off, fresh off the printer is the updates for how the economy was impacted so far by the coronavirus. So we looked at what sales were for January 2020 versus February, end of February 2020. And what we saw is that retail and food services sales were down about 0.5%. We saw that bars and restaurants were also down about 0.5%, but sales at non-store retailers, aka Amazon, the internet, you can see were up slightly. So this was when it was just starting to have a little bit of an impact. So, not significant surprises here, just a little bit down and a little bit up. I think what will be more interesting for us to see is when the March numbers are done, because that's going to give us really more insight into how this is actually impacting the economy. Because we can see here in February, really not much of an impact. We've also seen the US government coordinating its responses across all the different branches. There is a stimulus package right now, and I looked this morning, has not been approved. There seems to be some politicking, unfortunately, coming into place, and obviously we do need this to get passed soon. But what we do see is a $1 trillion stimulus package that is on the horizon, with $250 billion being paid directly to you, taxpayers, by the end of April in many different ways. But one of the most talked about is checks ranging from about $1,200 and up, and also a relief for small businesses, and $50 billion going towards small businesses. So there's a lot on the books. Again, we have to see how quickly this is going to be rolled out and actually what the final package looks like. The next section we're going to be looking at is the investment outlook and portfolio positioning. And Paul is going to be taking you a little bit through this. We've got a lot here that I think will help put all of what we're going through into context. Are you ready there, Paul?
Yes, I am.
All
And
right.
so this is where we take out our crystal ball and we tell everyone exactly when the market's going to recover and exactly by how much. But now, of
I
course,
wish you knew that. I wish you knew that, Paul, because that would make our job a lot easier, wouldn't it?
of, of course, as we know, that doesn't exist. However, the good news is that if we look at history, and this is where our attorneys have to tell you past performance does not indicate future results. Um, but what we've seen time and time again is that whenever we do see market downturns, especially as dramatic as the one that we're seeing right now, in the short term, intermediate term, and relative long term, and we'll talk about more specific numbers here, we do see rebounds and strong and sustained rebounds. So as the slide here says, US equity returns following sharp downturns, and those equity returns are positive. So in other words, stocks, so the US stock market as a whole, uh, historically outperforms what its typical average is following major stock downturns. So if we're looking at the bar graph all the way on the right here, because
Mhm,
this is the environment that we're finding ourselves in, this 20% plus market decline. And
mhm.
if you
Similar to
hear
what
the
we're going through right now, right?
exactly, so if
Yeah.
you hear the term bear market, this is what a bear market is. It's when you the stock market reaches its top, which happened last month. I believe February 12th was the exact date. From that market top, what kind of a drop do you subsequently see? So you can see we've got data for 10% market declines. We passed that. 15% market declines. Unfortunately, we passed that as well. We've passed that threshold of 20% market declines, and so now we are in a bear market. Now, the good news is that relatively speaking, it is a short-term event. We've seen it happen time and time again. This is not the first bear market. It won't be the last, unfortunately. And so that orange horizontal line there shows stocks as a whole going back almost 100 years, so including even the Great Depression. On average, every year, the US stock market returns about 9.6%. So let's just round up to a nice 10% on average every year. Unfortunately, it's not the nature of the stock market that you're actually going to receive a 10% return if you have your money invested in the US stock market. That would be too easy. So what happens is following a downturn like the one that we're going through right now, on average, 1 year after an event like this, the average return is 14%. So in other words, it outperforms the historical average by about 4%, because as is expected, there's some room to make up for. And then the 3-year average, which is shown by that lighter greenish color there, is 11.5%. And that's an annual average for the following 3 years. And then we look at the 5-year average return, and it's even higher than that 3-year average. It's almost 12%.
Hmm.
So what
So what
happens
so
is,
so Paul, what you're
yeah,
saying is that after a significant market decline, like what we're going through right now, a 20 plus decline, that shortly after, on average, the market returned 14%. And if we look at the 5 years after that significant 20% decline, that market averaged almost a 12% return each year for
that's
those
right.
5 years right after.
That's right. And a similar story played out
Yeah.
11 years ago following the Great Recession, which uh, that the downturn there was closer to about 50% in stock prices.
Hmm.
And so we did see a relatively quick market rebound. And that's
Yep.
evident on the next slide, if we
Yeah.
turn to that one.
Li-
So this looks at just the S&P 500, so the 500 largest US stocks.
And this
And
goes
this
all the way back to 2000, I see.
this is 2000, so it recaps the last 20 years as of the end of 2019. And what we see here is that if someone had invested $10,000 January 1st, 2000, Y2K,
Hmm.
which by the way, that coincided with the tech bubble burst. Then there were a few years of positive stock market performance. Then 2008 happened, market dropped almost 50% in value, and then we've since seen about an 11-year strong market run since then. And so it would have been really tough as an investor to stay invested during that time. And you can see all the little ups and downs. But by the end of it, you would have more than tripled your money had you stayed invested, even through that
Hmm.
50% downturn that
Yeah.
happened 12 years ago. And so it remains to be seen just how quick this rebound is. However, what this shows, even in just 20 years, which for the stock market, it's not a short time, but it's also not the full market history, you can
Hmm.
see that for every downturn, there is an upturn. We saw this even in 2018, which was only 15 months ago, where there were fears of a recession
Hmm.
and the
Yep.
market dropped 10 to 15%. If you panicked, you would have missed out on what was a very strong January 2019 and a really strong 2019 as a whole, where we saw markets go up by 30%. And when I say markets, specifically the US stock
Hmm.
market.
Hmm.
Now, we know though your portfolio is not the market. This is just looking at US stocks. So, really, that roller coaster ride that US stocks tend to go on. So, the following slide is more indicative of of a portfolio that we would recommend. It's a balanced portfolio, 60% in U.S. as well as non-U.S. stocks, 40% in different types of bonds. And this looks at different crises as they've happened over the last 30 plus years. What's happened to the stock market recently is actually very similar to what happened in October 1987. So it's that event all the way to the left there that Stacy is indicating, where we saw very sharp stock market declines. We saw days of losing 10, 12%. So that should sound similar to what we've seen in the last few weeks. And what this chart shows, and we can talk about some of the other events on here as well, it's similar to what we talked about just a moment ago, how resilient the market is. And it's not just about stocks, but even a well-balanced portfolio, you will see some pretty immediate rebounds. And so with that 1987 crash, if you stayed invested in a 60% stock, 40% bond portfolio, 1 year later, you would have seen a positive 19% return.
Wow.
3 years later, it would have been over 30%. 5 years later, would have been up over 75%.
That's
And
amazing.
and
That's
so
amazing.
it is. And so that is our concern with, and it's a natural instinct for people, humans by natural inclination. We don't naturally have the stomach for investing. We do want to protect ourselves whenever there's an immediate threat to our wallets, to us, to our livelihoods. And so what we want to do is cut and run. But
Yeah.
unfortunately, that is exactly the opposite thing that you want to do. You've already been hit. You have to ride with it for a little bit, and then you can see that you are immediately rewarded for your patience. And so even the September 11th, 2001 attacks, the following year, market hadn't quite recovered. There was again the issue of tech stock bubbles. There was war that broke out. So the 1 year return was about flat. However, the 3 year return, 40% cumulative return, 5 year return, 81%. So a massive rebound there.
Wow. Yeah. So that's after September 11th, and look at that. 5 years, over 5 years, had 81% return.
Exactly.
Yeah.
And so our outlook is that yes, this is of course going to have an immediate short-term effect. Our outlook for the long run, however, has not changed. What the underlying economics, how strong they were beforehand, plus the stimulus that is taking a little longer than expected, but will eventually come from government here, from central banks in Europe, Japan, and other economies, that's going to help small businesses, it's going to help individuals in the short term. We feel that in the long run, the long run economic trajectory is still intact and still moving in a positive direction. And so assets are valued based on long run projections of profitability. If they can't make it during this time, then that's not a company stock that you want to own in the long term anyway. And so that's the way we build our portfolios, is we're holding bonds that are US government treasury bonds, that are high rated corporate bonds. We don't invest our clients' money in junk bonds because of times like this, where a company doesn't have those strong balance sheets and is able to survive an event like this, and they might have to default. So that is why we shy away from investments like that. And then third, really you want to make sure that you plan how you're investing with what your cash flow needs are. And so that is part of why we do financial plans for all our clients, is to make sure that the amount of risk that they have in their portfolio is appropriate based on what their cash flow needs are. So if we think back to those slides that we just went over, someone who doesn't need money from their portfolio, they're okay with having exposure to that roller coaster ride of the S&P 500. For someone who they're in their retirement, they're pulling money out, then they do want more of that balance between bonds and stocks. So you can't invest in a vacuum. You do have to assess what is going on in your life in terms of cash flow. And so leave you here with a quote from one of our most trusted research partners, Dimensional Funds. They say sudden market downturns can be unsettling, which amen to that. Sticking with your plan puts you in the best position to capture the recovery. And for all of you, for all of our clients, we do have that plan and we are sticking to it. If anything drastic has changed, that is why we're proactively reaching out to everyone to make sure that the plan still works. If it doesn't, then we just have to make some minor tweaks.
And that really comes down to financial resiliency. And it's interesting because not many people talk about financial resiliency, but there's been a lot of talk about resiliency, emotional resiliency. Our firm, we have a book club, and you'll kind of giggle, but we read books that help us better serve our clients. And one of them is Plan B by Sheryl Sandberg, and it was really about resiliency after losing her most beloved husband. And resiliency is what gets you through those very difficult times. And financial resiliency is also something that's really important. And what's interesting is that often we don't realize how resilient we are. We put together this chart. It's the source is the National Endowment for Financial Education. They commissioned a study back in 2017 to really see how frequently do we have these situations where we have to live through a significant change in our financial circumstances. And we looked at these different age ranges. So, and the question was, have you experienced a 10% drop in earnings at least 4 times? And you saw those individuals aged 35 to 54, 3/4 of them had experienced a drop in their earnings of at least 10%, at least 4 times in their life. If you go out to the individuals aged 66 to 70, that number is nearly 100%. This is another question that they then asked. Have you gone a year or more without earning any money? So have you gone a full 12 months without any dollars coming in? And you can see half of all uh, Gen Xers, 35 to 54, again, 56%. And when you go all the way over to the right, that by the time you reach age 70, almost every single person, 93% of them have gone through a full year, working life year, without any income. And it may be to a layoff, it could be an illness, it could be a divorce. But again, I think what's really powerful to know is that we all have experienced this, we all will experience it. And what's most importantly is being able to bounce back. So, how do you do that? Well, I'm going to tell you exactly what you need to do, and I'm going to tell you what I personally do. And the first thing is tracking spending. And right over here, um, I have my printout of our credit cards, and I go through them every month and I look at it and make sure that everything is right. And also see, are there things that we can possibly reduce? And that's that second piece of cutting costs, because cutting costs, uh, essentially the best way to do more with less is to make sure that you're prepared and your costs are less than your income. So that's really key and important. So that's something that I actively do to try and make that our living costs be as low as possible, yet live a wonderful life. An emergency fund. Although emergency funds are intended for emergencies, um, an emergency would be, for example, losing your job, having income reductions, um, potential larger expenses for certain reasons. And ideally, you want 6 months of your living expenses. And when I say living expenses, I mean your housing, your food, your health care, your car, miscellaneous items like, clothing, household supplies. These are all things that are part of that quote unquote emergency fund. Now is also a really important time to tackle high interest debt. There's a reason why those minimum payments they say on the top of the, in fact, I look at this and it tells me, my minimum payment here, it's really low. It's about $150. Um, the reason why it's low is it means that if I just pay that minimum, I'm going to be in debt nearly forever. And so it makes a lot of money for the credit card companies, but it doesn't put money in your pocket. So making sure that you reduce that debt, high interest debt, credit card debt as much as possible. We're also going to go through some sections going forward. There is some more flexibility for you with those credit card payments if they're overwhelming based on what you're dealing with your income. Now, this is easier said than done, but make more money, right? But for many people, it's very possible. I was working out with my trainer this morning. We now do virtual via our iPhone, and we're actually going to be having her offer training for you as well. And her business has actually gone up in value. So she's making more because she decided to move everything online. So maybe it's getting back to writing, or maybe it's starting to work on publishing a book, trying to think about great ways to make more money. It could be renting out a vacation home, it could be freelancing. Just again, thinking about things you can do. Um, this is really important. These last three are really important. This is a good idea, a good time to look at your insurance coverage. Look at your auto insurance, your homeowner's insurance, your renter's insurance, as well as your liability coverage called your umbrella insurance. The vast majority of individuals are not insured correctly. And when I say not insured correctly, it means that you may have too much coverage or you may not have enough. So this is a great time to look at that, as well as review life insurance, disability, and long-term care. We can help you look at that. We're fee only, we're fiduciary, we don't accept commissions, so you get the real advice, the real facts. We, if anything, are a little bit biased against having too much insurance, but now is the time to really make sure that you're okay, so that if there is anything that happens outside of your control, that you're protected. And finally, check your eligibility for assistance programs. There's quite a few assistance programs out there. Paul and I are actually going to walk through them right now so that you can take a little bit of a look. And the first one is taxes. So they have extended the filing deadline to July 15th. You still need to get your actual you still need to file your taxes by April 15th, but if you owe money to the federal government, you have until July 15th to make that payment. Now, don't delay filing. Number one, it still has to be filed by April 15th. But if you expect a refund, try and file as soon as possible so that you can get that refund in the works, as far as what that looks like. Now, on a state by state basis, this I'm just talking about federal, state by state deadlines may vary. So if you have any questions about that, just reach out to us. Credit cards. I talked a little bit about credit cards. That number one, we want to pay off high interest debt as much as possible. Credit cards being the number one offender. But what we are seeing is that credit card companies are lengthening their payment deadlines. They're also offering lower interest rates on cards. Um, they're also waiving late fees. So what I would encourage you to do is to reach out to your credit card company to see if you are eligible for any of these more favorable situations, more favorable um, rates. And Paul,
Mhm.
Paul's going to talk a little
Yeah.
bit about mortgage payments because there's a lot going on in this area.
Yeah, and so this one is state dependent. So this is for New York. I'll be honest, I haven't heard if there are any other states that are offering this right now. So you'll want to check in. Nevertheless, even for those of us here in New York, you do want to contact your mortgage provider to see if you will qualify. Right now, what we know is that New York will suspend mortgage payments for 90 days for borrowers who face financial hardship. Generally, that's being defined as you either have lost your job recently because of coronavirus pandemic, or you've been moved to part-time. And so the details have not been ironed out yet. This was announced by Governor Cuomo just last week, and that's why our recommendation is for you to actually reach out to your mortgage provider, see if they have any more information offered. But essentially, you can defer your payment for up to 3 months if you qualify. That doesn't mean that it's being wiped out by any means. So that 3 months will just be tacked on. So if your loan was due to mature in January of 2021, well, now it'll mature April of 2021. But again, check to see if you qualify for that. Next is student loans, specifically for government federal student loans. So if you've refinanced and you have private student loans, this does not apply to you. What is happening here is that student loan interest payments will be waived. Right now it says indefinitely. Think maximum two, or I should say 2 to 3 months for now. Um, this one is good because this actually lowers your total payment because they are actually waiving any interest for this period of time. If you are in the position to just keep making your payments as is, that's great. This will actually save you some money in the long term. And this doesn't apply to, you don't have to meet any criteria other than having federal student loans. And then lastly, unemployment insurance, which is always around, but we just want to remind you that this also does exist. There is, I believe, a 1 week waiting period where if you have lost your job, that you have to wait a week and then you can apply for benefits. And the New York website is here. It's www.labor.newyork.ny, I should say, .gov, and you can log on there and see if you qualify for any unemployment benefits.
And Paul, I was also reading that New York in particular was extending benefits as well.
Mm.
So those people that are currently unemployed, that there's a good number that is going to be extended, which is great
Yeah,
news.
and I imagine to those of you at home, to us as well, this is a fluid situation. We'll try to keep you updated as much as possible, but it seems like every day there are new programs coming out. So that's
Mhm.
why we urge you to check out these websites with mortgage. Call your mortgage provider because we don't have all the details right now, but as soon as we know them, we'll
Yep.
circulate them.
Yeah, and also for all of you listening, we'll make sure that, again, every Monday, as soon as we get those details, you bet it's going to be in here. And we'll
Mhm.
be recording all of these too. Um, let's go through some self-care because this is really important. I actually worked out this morning. I shared that moving my body is really important. I've been working out 4 to 5 times a week, and I will tell you, it's helped me. It's helped me so much. It's helped me dealing with being a better mom, and our kids are essentially remote learning here. It helps me be, I think, a better employer. Paul, you have to say yes to that, whether you like it or not. Uh,
I'll just nod my head.
you just nod your head, and hopefully a better partner. So really important. Routine is also important. I was talking to my mother-in-law. She's actually quarantined. She has severe health issues. She was able to beat lymphoma, but it was touch and go. And so her immune system in her late 70s is unbelievably compromised. So she actually cannot leave her home for the next 3 months in London. And we FaceTime with her, and she has a routine that she wakes up every day and she has coffee dates with her friends on Zoom. She's one of the hippest ladies you'll ever meet. But routine is really important. Reaching out to your loved ones is really important. We've been having lunch every day as a family, and each day we call and we eat lunch with either my dad, their Mimi in England, who I was just mentioning, their nanny who can't come here because she's over age 50. Um, it's really important. And then just realize we're not perfect. Practice self-care and self-compassion, and know that you're doing the best you can. And the other thing I have found that's really helped to me is to try to help other people. We love to bake, and we've been baking cookies and taking them down to our doormen who are working really hard. Um, our dog walker can't walk our dogs, but we've been continuing to pay him. It's not that much money, and I know it's making a big difference for him. So, whatever small things, it doesn't have to be monetary. It can be small gestures of just trying to help out. Um, we just paid a wonderful escape room in a box, and it's all of $13. And I'm going to go on Amazon and send them to a couple of our friends because I know they'll love to do it with their family. So just things. And we also wanted to share if there are any, if you do want to make a donation, these are four really important organizations, nonprofits that are really struggling and need desperate help to be able to help New Yorkers. And so we wanted to share these two for you. And making sure that you're healthy. I'm really excited. Please join us this Thursday at 5:30. We have Stretch and Tone with Laura Miranda. She is my personal trainer. She's also the trainer for the Francis Financial Office. She comes into the office and does private sessions with us to keep us in mental shape and as effective as possible. And we're continuing to do that online. And then also that next week we'll have yoga with our very own Deborah Donenfeld. I've given you the link. We'll follow up with the link out as well. Anyone is welcome to join us. So yourself, if you have children, if you have colleagues, friends, loved ones, we can handle several hundred people on the Zoom, and you don't even have to put your video on unless you want. So it can be whatever you want it to be. But please do join us. We are offering this for all the people that we really care about. So next we're going to go into questions. And I know, Paul, you've got a couple questions that you were going to, a few people called in with, and also I have a couple too. Did anyone put other questions on the chat
Yes,
bar?
so I do see one here, and this is a good clarification. It shows you just how quickly things are changing. Someone wrote in, I believe the filing deadline has also moved to July 15th. Could you please confirm? And that is indeed the case. So to make a revision to what we said earlier, it's not just payment has been deferred to July 15th, but you can actually file your taxes on you have until July 15th to file your taxes.
Well,
So
thank you.
thank you for that
Yeah.
clarification. That was announced a couple days ago by the IRS. So thank you for that. And so, which I'm sure CPAs across the country
I have a
are
big
liking.
sigh of relief. It's interesting as far as essential employees, what's essential and non-essential. CPAs are essential. And so
So they have to keep going in, huh?
yeah, yeah. I mean, we're actually, just so you know, Paul, and I don't want this to inflate your ego, please, but we're actually essential as well. We're on the list, but I know we're all working from home anyway, so
Mm-hmm.
just to be safe for everybody out there. But yeah,
Yep.
so one of the questions that I know someone had written in was, "Is there a recession coming?" And Paul, can you
Mm-hmm.
can you tackle that?
Yeah. Thanks for giving me the easy one.
Exactly, because we'll just get you diving right in.
So you know, we don't know right now. economists are pegging the chance of that of being over 50% at this point, that there is a recession, and just that there will be a recession. But just to take a step back, what a recession is, textbook definition, if there really is one, is a decline in economic growth, usually measured by something called GDP, gross domestic product, which just a fancy term for how much stuff does a country produce and services and in goods. Uh, so a recession is essentially saying that an economy of a country is not going to produce as much stuff as it used to produce for 6 consecutive months, for 2 straight quarters. And so right now it's too soon to tell that what's going on right now is going to have that much of an impact. Most likely it is. However, we can't say for certain. The average recession lasts around 11 months, so more than that 6 month minimum that is part of that definition. And the other thing to know is that this is normal. The R word has been mentioned now for several years because the last one was in 2008, early 2009. So in a way, we have been overdue for a recession. Most adults have lived already through 3 of them. There's been over, I believe, 11 in the last century. So it gives you an idea that usually there's one every 8 years or so. Um, Something else to keep in mind is that it also doesn't necessarily move in lockstep with the stock market. Typically, stock market declines happen before a recession is actually identified. You can only really tell a recession has happened what's once it is in the rearview mirror or you're kind of in it. The stock market tries to predict it ahead of time. So it could be that we see a recovery in the markets even while we're in kind of the later stages of a recession, if that were to happen.
That's interesting. A good follow-on question that someone had said was, "What's the worst case situation?" And I mean, the worst case situation is that we go into, that the coronavirus triggers a global recession. The good news is, and I spoke a lot about this last week, going into the situation, the economy was phenomenally strong. I think of it almost as like a Marvel superhero, and the reason why I bring that up is we've been having to watch a lot of Marvel superhero movies in our house because that's the one thing that the kids seem to agree on. But very, very, very strong. You know, Regardless of the severity of the recession, um, your portfolio is already prepped for that. And when I say that for our clients, I'm talking specifically about the bond holdings. And it's really important not only to have bond holdings, but the types of bonds. So making sure that you are ready to weather whatever comes our way. And that means that you have short-term, really high quality bonds. Paul talked a lot about treasuries that are backed by the full faith of the US government, which are really important and key. And it's also important to know that, the Great Recession of 2008, stocks were down 38%, actually significantly worse than what we are today. Right now, I looked at this morning, and it was about 22, 23% down in the S&P 500 so far year to date. So we haven't hit that yet. But what's really important to know is that during that time, these high quality bonds actually did phenomenally well, and they were very positive. They were positive over 2 percentage points, which is pretty phenomenal, assuming stocks took a 38% dip. So what's really important is to make sure that you have that right allocation and that you are invested for the long haul, because Paul, you did a great job and very eloquently explained that after a severe 20% downturn like we're seeing now, that we see returns on average, upwards of, 12, 13% each year for 5 years after. And we want to make sure that we're still here in the market to take advantage of that.
Mhm.
So Paul, there was another question, and I don't know if you don't mind fielding it. Um, what should the question was? Someone wrote in, what should I do with my money? And is now time to invest more money? In fact, we had a client this morning who emailed us that has additional money on the side um, that they want to invest. So, can you
Yes,
tackle this one?
and so normally that is music to our ears whenever a client says, "Hey, I've got money to invest, let's do it." Typically, that's a no-brainer. However, we do want to make sure, especially in a tenuous time like now, that they're meeting certain criteria. And Stacey, you touched on it in one of the earlier slides of making sure you have an emergency fund. So having that cash on hand in case, even if everything is okay at work and your job security is fine and that you're not anticipating any sort of income downturn, that if something were to break around the house, if you had a unexpected medical emergency, that you have enough cash on hand to cover that, that you don't have any outstanding debt, especially credit card debt. So priority there is to use the cash to pay that down. But I would say more uh, talking about what's going on now, it's really about, are you that confident about your job security for the next few months? Most people that we're speaking with are. And so then, yes, it could be a good time to invest. An easy way to do it is, if you're not already maxing out your 401k contributions, just to increase that up to the maximum, which for those under the age of 50 is 19,500. For those above the age 50, you get a catch-up contribution, and the total jumps up to, I believe,
Mhm.
$26,000. So that's an easy way to A, defer taxes by increasing your 401k contribution, and B, your 401k is invested
Yeah,
most likely at some portion in the stock market. And so you are achieving also that goal of buying into what will prove to be a relative low, um, to be rewarded in the long term with when the stock market rebounds.
yeah. I'm going to go to the last question and make sure that we, finish up because I know everybody has a lot going on. I want to keep this under the hour. A person wrote in, I don't have the long term to recover from this. When do I pull the emergency cord? Um, so the question, is long time to recover. And this was actually written to us by a lovely lady who is 55. And so I would challenge that she actually does have a significant amount of time to recover, because this portfolio is meant to last out for another 40 years for her to age 95. And she also is taking distributions from the portfolio, but the amount that you are taking in distributions, for her, she has 4 years before she would ever have to touch any of her assets that have gone down in value, because we have so much that we have in high quality bonds that have gone up in value, as well as also a little bit in cash. But it's hard to ignore you know the the talking heads of you know selling and getting out and going to cash. And when you look at who's actually doing that, it's not individual investors like you. It tends to be more so institutional investors. And those institutional investors, just so you know who exactly is an institutional investor. It's commercial banks, mutual funds, hedge funds, pension funds, insurance companies. And the reason why they tend to bail so quickly is truly self-preservation. These people, their jobs are, really much, very much dictated about how much they gain or lose for a client, and so they tend to be the ones who sell really quickly. And if you sell too quickly, you're not nearly punished as bad in that type of an environment than someone who hangs on and sells much later at a big loss. So that's why what we've seen a lot of people exiting the market, but it's not individual investors. It tends to be more of those institutional investors. I wrote an article over the weekend that I was really enjoying writing and researching. And one of the things that I was looking at is how day traders, these institutional investors, how they perform versus the market compared to how individual investors like you perform. And what we saw, Barber did a great research study specifically on this, is that they found that day traders actually performed 5 percentage points worse than individual investors. So that is something to know too, that this day trading and timing the market of getting in and out, these individuals tend to underperform long term. And we're not only talking about underperformance, we're also talking about they're having higher fees, higher taxes. So, really, long term investors, when I say long term, and I just want to be very clear about what that means you have this money, a time horizon of 5, 10, 20, 30 years out. And Paul is 100% right that if you want to take advantage of this market, do exactly what I did. And that is I upped my 401k contribution to try and get it done in the next 3 to 4 months. And that's where I can take advantage and have that money work for me. And what's nice, I mean, I don't plan on retiring till I'm in my 70s. And I know that
Mm.
my staff, I think you guys made me sign a little form that allows you to tell my husband when I shouldn't come to work any longer. And I have my
Let's
my
let's keep that to early 70s at
Okay,
the
early
most.
70s. Okay, so we might be instituting a mandatory retirement age because of me, but I don't plan on touching that money at least until my 70s when I'm needing to take out my required minimum distributions at 72. So, um, but yeah, but most importantly, I just want to tell you, you know, this this is this is a scary time, and this is where we do our best for you. We are here. We've always been here for you. But in times like now, we want you to reach out to us because you're not alone. And we're going to continue to reach out to you and be proactive. And it's not because we're worried about the economy or the market, because we are not. We know that we will recover and we will return to the wonderful bull market that we just experienced. But what we're more concerned about is we just want to make sure that you're okay and that you're healthy and that you're feeling comfortable and that you know that you're not alone. So I just want to say thank you for listening in today. We're going to be sending you the recording by tomorrow so that you can send it out to your loved ones, the people who you care about, to again understand what's going on and get the information you need for financial resiliency. Thank you again.